Oatly stock is down 96% since it IPO'd in 2021, and in this video I am going to do an in-depth analysis of the company by looking at the financials, the forecast, the balance sheet, using my spreadsheet to calculate the intrinsic value and future returns of Oatly, well as looking at the main risks of investing in this company. Starting with their financials, their revenue growth has slowed down massively in the last 3 years, and it is currently at $828 million. And according to analysts, revenue growth is expected to continue to be slow over the next 4 years, as they're only going to reach $974 million in 2028, which is an average of 4% per year. This is an unprofitable company. However, their losses have decreased over the past 2 years, and they are currently $194 million in negative net income. The problem is that analysts are expecting them to keep losing money, as they are expected to make negative 35 cents per share in 2028. This is the main problem about this company. However, I will say that their gross margin is pretty good, as it is currently at around 30%. However, as you can see, profit margin is currently negative 23%. In order to calculate the intrinsic value of Oatly, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value for Oatly according to my low assumptions is $7 per share, middle $22 per share, and high $44 per share. The stock is currently trading at $16 per share, and therefore this means that if my low assumptions occur, you're going to make a negative 4% annual return on your money, middle positive 16%, and high 30%. In terms of my assumptions, I assume the company grows revenue annually between 2 and 6% over the next 7 years. They average a profit margin and free cash flow margin between 2 and 8%. This is obviously the hardest part about valuing this company, because we don't know what their profit margin or free cash flow margin is going to be in the future, as it has always been negative, but I have to assume something. And I also assigned a P/N price to free cash flow at the end of the 7 years of 14, 16, and 18. If you want to do your own assumptions, I'm going to leave a link in the description below. It's super simple to use because I've done all the calculations in the background, so you only need to do your assumptions. Moreover, Oatly has a horrible balance sheet as they have $67 million in cash. However, they have $492 million in debt. This is a lot for a company that has a market cap of $506 million. The main risk of investing in Oatly are the following. Number 1 is that they are still operating at a loss. Although margins have improved, Oatly is not yet profitable and is not expected to achieve profitability in the next 4 years, which is a lot. Number 2 is low revenue growth, which is expected to be at around 3% in the next 4 years. Number 3 is the volatile raw material costs. As a manufacturer of oat-based products, Oatly is exposed to fluctuations in commodity prices like oats. Any rise in raw material costs could squeeze margins, delaying its ability to reach profitability. Number 4 is the competitive plant-based market. The alternative milk space is crowded and competitive. Consumer preferences can shift rapidly, and larger players may outspend Oatly on R&D or marketing, making it harder to maintain market share and pricing power. And lastly, the execution challenges. Oatly has struggled with execution in expanding production capacity. Delays and inefficiencies have previously led to inconsistent supply and lost partnerships, for example the Starbucks one, and have eroded investor confidence. And because of all these reasons, I am not going to add Oatly to my stock portfolio. I believe this company could have potential, but they need to start making money. I hope you found this video valuable. Let me know what you think about Oatly stock in the comments, and I'll see you in the next one.